Paul, welcome to the show today.
Michael, it's great to be here.
Yeah, it's going to be fun jamming with you a little bit. I do want to talk about the fact that when we both got started in real estate, well, you clearly long before I did, Paul, but we both got started in single family houses, like not just like a one or two, but like pretty significantly. And I want to talk about that because I don't. Maybe we can spare some people the years of agony and frustration in that. But I'm curious to know, when you got started in real estate, what did you do, and what kind of things did you do, and for how long?
Yeah, so my friend moved to town and I was bored. I was running a nonprofit and it was only taking about 5 hours a week. And he was like, "What do I do? I got all these maintenance skills." And we heard from this friend of ours that you could actually go to the courthouse steps and bid on houses. And we thought that sounded really fun. So we actually intentionally didn't take any money with us just so we could go learn. And we were thinking, man, there's houses worth 65,000 here in Southern Virginia. That was pretty easy to comp. If it goes for less than 40, it's in perfect shape. It's going to be amazing for somebody. It won't be us, of course. We got to the auction. We were the only people there. They came out at 32 or 33,000. We begged the lady to let us run to the bank and come back, and we did. We bought it. We flipped that house. We put a for sale by owner sign in front of it a few weeks later and sold it in 4 hours, full price. And we thought, this is so easy. We can do like 3 or 4 of these a month. And it was going to be so much fun. And then we lost money on the next two houses.
They get you. It's like the slot machine. It gets you. And it keeps you coming back.
Yeah,
Yeah,
right.
that's
But anyway, yeah, we flipped a lot of houses. And at one point, I thought, this is so much fun. It's not even like work.
Well, to me, actually, it did feel like work. Though, having said that, I just thought the profitability was pretty cool. I mean, this was
Yeah.
back in 2009. We were buying. This was out in Maryland, outside of DC. We were buying stuff for, well, we were buying like 110,000, putting in like 30,000, and then selling it for like 185,000. The market started to recover in 2009, 10,
Yeah.
11, and I thought I was like I had arrived. Like it was my,
Yeah. Right.
rich dad poor dad. You're like real estate, and it took me 3 years to figure out that what I was doing actually wasn't passive income at all. Like
Right.
I don't know if that hits you at all, but I don't know. It took me 3 dozen houses to go, wait a minute, this is actually not passive income.
Right.
It has the word real estate in it, but that's it. And I don't know why it took me that long to figure out. I mean, how long did you do single family house investing for? And you did brokerage and stuff too.
Yeah, we started in 2000 and we went between that. We also flipped land, like waterfront lots at Smith Mountain Lake,
Right.
and built 7 or 8 modular homes. So that was like 80 or 90 total sale, flips. And I think we did our last one around 2009 or 10. And I realized the same thing, Michael. I said, well, hey, I'm just feeding money in, living off a little of the profit, feeding money out. Warren Buffett said, unless you learn to make money while you sleep, you'll have to work until you die. And I wasn't on that track at all.
Yeah. Well, when did that realization come for you? Because I felt the same way. I mean, it took me such a long
It,
time. It wasn't really until I accidentally got into my apartment building in 2011. It was accidental, and that was a nightmare. It didn't go well for me at all until it finally quieted down. And then the thing was sending me like $1,500 a month in mailbox
yeah,
money.
I remember you had all the lawsuits going and that
Yeah,
DC
yeah,
stuff going on.
exactly.
Yeah.
So it really actually wasn't until like 2012,
Mhm.
until it clicked for me that that's actually more like passive income.
Yeah. It was the same year for me, 2011. We actually we were investing or speculating, I should say, in oil and gas in North Dakota, and we realized that there was no place to stay. There were oil workers sleeping in their cars and their pickup trucks and their trucks, and you know, uh, pulling RVs into town at 30, 40, 50 below zero in Minot, North Dakota, and Watford City and Williston, North Dakota, especially. And we were like, hey, you know what? We just lost $1 million investing in oil and gas. Maybe we can make some of that back by investing in housing. So we bought 76 acres of unzoned land, Michael, near Watford City, North Dakota. And we started a housing project, and within 3 months, we had a bunch of cabins set up, and we were housing oil workers in 300 square foot units for $4,000 a month and staying full.
Now that was passive income, wasn't it?
It was, yeah. I mean, once we got the people in the units, it really wasn't hard at all.
Is that kind of when a light bulb went off for you a little bit?
Exactly. That's when the light bulb went off. And I hadn't heard that Buffett quote yet, but when I heard it, the quote matched my experience over the last several years. Yeah.
I don't know why it takes us so long, Paul. And there are so a few that skimp the single family house investing stuff, but many don't. And there's still a lot to this day where I'm talking to, and their plan is just to buy another rental or another short-term rental or something.
Yeah.
And really, if you sit down and you do the math, you just don't get to where you want to go. People, I got to cover $10,000 per month. Okay, well, how are you going to get there with a rental that makes $200 a month? And what if your tenant moves out or something breaks?
Yeah.
You're making $2,400 a year, and then something breaks and your profit's gone. Like, have you thought through that?
Yeah, we rented a few of those houses out, and when a roof went bad or a furnace or something like that, we were realizing, man, this is really a long game. This is a game for appreciation and paying down the mortgage over decades. And what it clicked to me, I think, what happened is I talked to a guy who had 104 individual units around Cincinnati. And then he's like, wait a minute, I bought a 150 unit apartment, and like in one place with one snowplow, one maintenance person, no driving around town to fix toilets. They're all there in one place. And it makes so much more sense. And he sold all his single family rentals off. And that same guy taught me that commercial real estate's not based on just on the appraisal. There's an element of that, the market sentiment, if you will, called the cap. It's built into the cap rate. But, the value of commercial real estate's not based on the other houses in the neighborhood. It's based on comp. It's not based on comps. It's based on math. And the math, of course, is value equals net operating income divided by the cap rate. And if you can increase the net operating income, and there's definite ways to do that, pretty certain ways to do that in multifamily, then you can increase the value of your property.
That's a good point. I guess I will scratch my head when you have two houses. Let's say they're identical next to each other. One is an income property and one is a primary residence, right? One actually makes money for the owner and the other one basically just costs you when it's a liability versus an asset. And they're both valued exactly the same. They're basically valued as comps in the neighborhood, which doesn't make any sense to me at all. Like, this one box produces income for somebody, the other box basically doesn't. Why would they be worth the same thing? And like you said, in commercial real estate, it appealed to me more because there's two boxes identical to each other, the exact same size. One makes more money or income than the other one, and then because of that, it's worth more. Therefore, I can buy a box that's not making as much income, make more income like the other box, and now it's worth more. Whether the market goes up or down doesn't really matter. I can control the value of that. That really makes a lot of sense to me.
Yeah, it really does. Our moms told us to do well in math, and now we know why, right?
Yes, except for I took all this advanced math. Like, literally, I think I probably have calculus 3 or something.
Yeah, me too.
Like it's so dumb. I don't know. First of all, I don't remember a bit of it. I got an A in these classes. I did like 10-page proofs, Paul. I must have done well somehow, but anyway. I don't think we need much past algebra, frankly. Maybe a sliver of geometry.
Yeah, that's right. You only needed division,
multiplication,
value
maybe.
Is
you know what? All we
NOI
need is a spreadsheet,
by
Paul.
cap rate.
Everything is fine with a spreadsheet. That's it. That's just graduate in spreadsheets. All is solved.
Yeah, that would have been a worthwhile class to have, wouldn't it?
Yeah. So
Warren Buffett doesn't know how to use a spreadsheet.
You know why? Because he can do it in his head probably, which I can't do.
He can.
Yeah, exactly right. Yeah. But the thing about commercial real estate and the question is, why don't more people do it? Like, what do you think?
I think because there's so many barriers to entry. Number one, you've got all these long-term owners who are, let's call it the old boys club, although I don't think anybody calls it that really, but they're trying to keep us out. They're in there, and there's so many good ways to keep us out. Number one, the first time I made an offer on a piece of commercial real estate, I actually made a full price offer, $8.5 million for a piece of land in Houston, and didn't get a no. I got worse than a no. You know what they said? Nothing. They didn't reply to me. They didn't know who I was. And they basically, these brokers are motivated by people who put gas in their BMW and food on their kids' table. And if they don't know you, don't think you're going to really be able to close, they ignore you. And so that's one way of keeping you out. A second way is you got to qualify for a loan. You've got to sign your name on a multi-million dollar loan document. A lot of people can't do that. And so even if you had the money in the bank, you don't have the qualifications of running a multifamily property. So there's so many reasons they need someone like you, Michael, to teach them the ropes and get them to where they can qualify.
So fine. There's a little education that's or maybe a lot of it education. But now knowing what you know, is it really that hard to break into the game? Let's talk about some ways and maybe some mindset things. Like I always say that your single family house investing mindset does not actually allow you to be successful with commercial real estate. In fact, it actually will harm you. You almost have to unlearn things. Like when I got into it, I applied what used to work for me for the house flipping, even the rentals, and it simply did not work. And so I just kind of dug in. Like for example, I was looking on MLS for apartments. This was back in 2006. I was looking in the MLS. That didn't work. Then I was looking on LoopNet, and that seemed to work, but there was nothing penciled at all, right? And then I finally figured out that, that LoopNet is where deals go to die. So I, like you, I called up brokers. And we know what they did to make me go away. They didn't ignore me. They said, hey, Michael, this is cool. Why don't you send me your proof of funds, and I'll send you some deals. And I'm like, well, I don't have any proof of funds. And I was stuck. They never got any deals, right? So I was trying. I even sent yellow letters, right? Because that's what we did in the house flips. Like I did all this stuff using what I thought works because it's real estate. It's got real estate in the name, and it didn't work at all. So let's talk about some of the things maybe that you use to kind of break into commercial real estate as well that maybe require a little bit of a different strategy or even thinking.
Well, as you know, you and I have been friends a lot of years. Years ago, we concluded that we were failing at connecting with brokers. We were failing on getting the inside track. Part of the reason is there are a lot of people who were trained by certain trainers in Texas, for example, who had a whole bunch of students coming out competing against each other, bidding these prices up to 10, 20, even 30% below what they really, above what they penciled at. And so because they were bidding them up so high, we weren't willing to play that game. So we extracted ourselves and said, hey, we're going to be a fund and we're going to look for the best operators we can who have the inside track with brokers, who are succeeding, and we'll invest money with them. And we did that in mobile home parks, self-storage, multifamily, and more. And so we basically extracted ourselves from the game. I'll tell you this, the best operator we have worked with has been in the mobile home park and self-storage space. And they've got lists of these mom and pop owners all over the country. And they have literally 8 people sitting in a room calling, texting, emailing, voice messaging these people 8 hours a day, 5 days a week each. And that's how they're staying in front of these mom and pop owners. I think that's the way to do it in commercial. And it's really hard to do that in multifamily.
Yeah, it is really hard to do in multifamily. It highlights the fact that especially with a syndication, right? You really kind of have two roles in as an operator, syndication operator. One is kind of the deal finding role, and the other one is more the capital raising role. And yes, there's the asset management role. I get that, but you kind of gravitate more to the capital raising route. And in our ecosystem, there's about a 50-50 split between the two. Half the people gravitate from a personality perspective. They're more numbers oriented, more detail oriented. They gravitate naturally towards deal flow, analyzing deals, talking to brokers, and they resist raising money because it's not they don't, from a personality perspective, they don't really love it. And others are exactly the opposite. They don't really like numbers at all, but they have no problem talking with people, and they gravitate more to our capital raising route. Now, most people, especially when they're deal finders, their biggest hang up getting into commercial is, in fact, money. They're like, yeah, shoot, I mean, I'm sure I could figure out how to talk to brokers to get deal flow. Their biggest hang up is money. Why of the two Was that somehow easier for you? And maybe, is it possible that raising money is actually easier than people think?
Hmm. Well, that's a really interesting question. So the way it happened, Michael, is my business partner and I think the three of us met for lunch once, if I'm not mistaken, about a decade ago. He had another business, and he was charged with connecting with brokers, being a deal finder. I was charged with raising the money, and because I didn't have another business, I actually spent time. I wrote three books, two commercial real estate books, and one more about real estate. I got on hundreds of podcasts. I had my own podcast. I got on webinars. Thanks to you, I got connected with Bigger Pockets, and I actually had a show on Instagram and Facebook Live for years on Bigger Pockets. And because of that, I was able to get a following, even though I didn't have much experience. I'll be honest. I was able to get a following of, a couple thousand people on our email list. And when we had a deal, they were ready to invest because they trusted me. My partner, unfortunately, was not able to do that on the other side. And that's just honestly our experience. It doesn't apply to anybody else, really.
Yeah, I mean, it's now I remember how it worked out. You kind of really leveraged and you really became much more active online.
Yeah.
How did you get started raising money? Because that came up, I mean, you didn't start getting a Bigger Pockets in day one. Like, you actually had to raise money before, had you not?
Yeah, we raised money for a couple deals like that one in North Dakota and also a hotel. We sent letters to all the wealthiest people in North Dakota. That didn't work at all. We worked with friends and family, and that worked a little bit. But here's the truth. I had a mentor. It was the same guy who had the 104 houses in Cincinnati. And after about a year and a half of him telling me, you've got to go out and develop a system to raise capital, I just kept saying, I got this one big investor in China, or these two guys in China. And he kept saying, dude, you're out to lunch. You're out to lunch. You're not going to. I said, I don't want to develop a system. I was lazy, to be honest. And so, Michael, one day, actually, two different times I had a deal, one in Charlotte and one somewhere else. And I took it to the guy in China with all the millionaire, billionaire money. Both times, one time he said, that one's too small for me. It's only 4 million. We only write checks of like 10 million. The other time, I kid you not, he said, you can't ask me that right now. Chinese New Year's is starting tomorrow. Ask me it again in a month. I said, I haven't got a month. And so I called my mentor back, and there were other people on this call, Michael. And he said, Paul, listen, you haven't done what I said for 18 months. Don't come back on this call until you've done what I said.
Wow.
That was September of 2016, I think it was. And literally, Michael, there was I got some email that this famous multifamily author was speaking in Raleigh, North Carolina the next evening about capital raising. And I drove 2.5 hours down to Raleigh, and that's the day I met you. You were the speaker that night, and that's what launched me into capital raising. Thank you.
Well, that's interesting. Actually, I didn't know that. So what system did you then develop? So you got your butt kicked a little bit by this coach, rightly so, because you knew better, obviously. So what was that system that you developed?
The system was I wrote a book and I self-published it. Then I used that book to get on hundreds of podcasts as a guest. And then I started blogging a year later on Bigger Pockets. And you made that intro. Thank you. And then I got a show on Bigger Pockets. And then I did some webinars. I wrote some ebooks for our website as kind of, when people would visit the website, they could, like sign up here to get this ebook. And that's the main things I did. I put about 148 blog posts out on Bigger Pockets last I counted. And all that just added together. It was a lot of little hard work that went on for years.
Yeah, I did the same thing, a lot of hard work. But now the question, so you did a bunch of stuff to attract people, and you said you built a list of about 2,000 people. They go to your website, they hear you somewhere, they go to your website, they download your ebook. But then what did you do? Did you do anything at all in the back end? How did you nurture them on your list? Did you speak to them somehow? What did you do to kind of try to, anything on the back end?
Yeah, we send them regular emails, just here's some information. Hey, did you hear this statistic? And we'd write a blog post around that. But then when we had a deal, we would just kind of, build up anticipation for that, Michael. We'd say, hey, we might have a deal coming. We're doing due diligence right now. Stay tuned. Next week, hey, we only have room for $3.8 million. We're going to open the doors next Thursday at noon. And we would just build anticipation, kind of your typical marketing thing. And then we would do a webinar, open the doors for registration, and people came in.
So you kind of parlayed that, and again, you took the route of becoming more of an online influencer to raise capital, and I love that. If you look at anybody that has raised capital at scale, which you have, that's the route that they have gone, and it's like you said, it's a big commitment. Typically, we say you should raise money one-on-one, and you can raise $1 million, 2, 3, even just one-on-one, just getting referrals and meeting with people, and you kind of decided, hey, I'm going to do this other thing. I'm gonna get more leverage if I do it that way, and I'm gonna create a fund or multiple funds, and I want to invest it with an operator.
Right.
Talk to a little bit about that model, the fund manager model, because if you want to raise capital, it seems to be the better way to do it right now is to basically be what's called a fund manager. How does that work?
Yeah. So as a fund manager, there's something that everybody needs to know, or if you're a capital raiser, and Michael, I know you've talked about this a lot. You can't just raise capital for other people's deals. You've got to go through some regulatory hoops, way beyond the scope of this time we have together. But basically, you're under the 1933 and 34 SEC Act, but you're also under the 1940 Securities Investment Advisor Act. And so somebody needs to check into that. Reach out to me if you have questions about that. But you've got to structure it in a way where you're either like a GP, a co-GP on the deal, or you're registering as an RIA, or there's some other ways to do it. We both know some people who have gone down the road of even registering as a broker dealer and getting paid commission on the deal or getting a split from the deal. But there's a lot involved to doing it right. It's not just another syndication.
And what's important when you set up a fund as well is that you're partnering with operators, right? So
Yeah.
who are you looking for when you're looking for these operators to basically raise for?
Well, Warren Buffett said price is what you pay, value is what you get. And so we're looking for operators who know how to identify and actually unlock intrinsic value. Intrinsic value would be, what's some examples? Here's a simple example. Somebody's got a great apartment, building with 100 units, but they've got 5 acres that they own with it that they're not using. Well, I mean, that's kind of a no-brainer. If it's in high demand, you can add more apartment units there. That's intrinsic value. A self-storage facility that has 5 acres out back, you can pave it or put gravel down and use it for industrial equipment parking or boat and RV storage, or it's got a little storefront. You can build a storefront on it. You can sell locks, boxes, tape, scissors. You can put a cell tower on the back, a billboard in the front. You can add U-Haul. You can partner with U-Haul and make thousands of dollars a month, which again, using our value formula, $3,000 a month, that's $36,000 a year. Divide that by a 6% cap rate, and you've just added I don't know what that is, but something like $1 million in value just by signing up to partner with U-Haul. And so it's probably 600,000, not a million, but you get the point. There's all kinds of ways to add value, and that intrinsic value is typically what a mom and pop owner doesn't have the knowledge, the desire, or the resources to employ, but you do as a professional operator. We're looking for those operators who know how to do that. But not only that, they can also put together, let's say, 20 mobile home parks into one big package and then maybe sell that for, let's say, $100 million to an institutional investor who's looking for, they don't want to write checks of $4 million each, but they might be willing to buy 25 parks for $100 million.
What is your outlook for kind of the market right now? Where do you kind of see that going? And you're invested in a variety of asset classes. A lot of them obviously are going to be very influenced by interest rates and the economy, things of that nature. So kind of what is your outlook? What are you seeing?
Well, Michael, at the risk of you and I starting another multifamily craze here. Let's be honest, the numbers for multifamily owners and syndicators are incredibly strong right now. There's a 3 or 4 million unit housing shortage. It's going to keep getting worse. They actually got a slowdown in building right now. You know, all those popular places like Texas and Phoenix and other places who had overbuilt and had negative rent growth, in other words, falling rents the last year and a half. They are now there's a lot less housing starts there, which means 1 to 2 to 3 years from now, the shortage is even going to be worse. Furthermore, the cost of owning a house is $800 or $900 in some cases, much more in other cases, higher to own than rent. And that is going to put upward pressure on rents in the coming decades. So between the supply and the demand, the housing shortage, especially in Sun Belt areas where people are moving, there's incredible favorability, great tailwinds behind multifamily right now, as interest rates drop a little bit, as a lot of the bad deals get sorted out of the marketplace in the next year. I think it's going to be another, there's going to be another boom, which I'm going to recommend people look, carefully at not turning it into another situation that turns into a bubble. And even if there becomes a bubble, you don't need to invest. You don't need to invest in bad deals. You can still find good deals even in bubble behavior when it's going on around you.
It does seem a little counterintuitive, Paul, what you're saying right now, because a lot of people are afraid. Passive investors are afraid. Active investors are afraid. There's a lot of fear in the market, right? So how does one reconcile, the fear of what's going on with what you just said right now?
Yeah, well, one way to do that is to find, go for affordable housing. There's a lot of luxury being built. I heard a statistic the other day that I haven't been able to verify yet, but apparently in the 2-year pipeline, there's about 500,000 units under construction. And only, Michael, if this is true, it's pretty amazing. Apparently, only 6,800 of those 500,000 units are truly affordable. So there's a tremendous opportunity. Our friend Neil Bawa is going after this, as you know, this affordable space. Another way to go after the affordable space is hotel conversions into multifamily, though I think that's risky. Another way to go about it is go after mobile home parks, which is another type of multifamily it's the only asset type I know of that has decreasing supply every year, but increasing demand. Powerful.
It's an interesting time we're in, because I do agree with you. Economic indicators appear very strong, yet the fear sentiment, the sentiment is still on the fear end of the spectrum.
Yeah.
And it's, I do agree with you that the opportunity there. It's just getting people to take action. There's always a delay. It's either on the fear or the greed spectrum. Like in March of 2022, when it was the height of the market, right? Everybody should have been running for the hills.
Exactly.
And that didn't happen for like 6 to 9 months when like there was really blood in the street. So there's always this delay in sentiment. So it doesn't really matter what the market feels like or what you feel like. The truth, it's actually always incorrect. So I think the trick is what we're telling people is to really dig deep, like what you're talking right now, and actually look at the economic data, talk to brokers, talk to other investors, see what's really going on right now. Because I do agree with you. Actually, prices turned about a year ago. If you look at the price index, it has kind of bottomed out and is starting to turn up a little bit more. Right. Even though, in a lot of our markets, rent is still basically flat. And so we haven't seen, like in Atlanta, we haven't seen an uptick, for example, in rents yet. But You're right. I mean, all the completions are going to be done here in the next, now, right? Yeah, or later the year. And that's it. So these new Class A apartments, they're dropping their prices to Class B levels. And that's creating an issue for Class B, it's unusual.
Right. It really is. And I think one thing to look at, by the way, I'm looking at a chart as we speak. I can send it over to you, Michael. It says that Atlanta As we're recording this, we're in the second quarter of 2025. They're in the declining vacancy, slight negative rent growth for about another 1 quarter. And then it says it's going to turn to, in other words, declining vacancy. That means the occupancy is rising. Negative rent growth means rents are still slightly falling maybe another quarter, and then it's supposed to get into rent growth territory again by the end of the third quarter of 2025. And as I'm looking across the country, Atlanta, Raleigh, San Antonio, Jacksonville, and Austin are the last, whatever that was, 6 holdouts of all these cities. The other ones are already turning back
Yeah.
toward positive rent growth now.
Yeah, there was a lot of new development in those areas, and they're being absorbed right now. So
Right.
yeah, so that's interesting. We're seeing something very similar about that as well. So it is a magical time to get into it, but it is hard, right?
Yeah.
Because even for us, we're like, well, shoot, we're in a flat rental increase market. How do we underwrite it? Well, we're not going to build in any kind of rent growth in the next year. And so
Right.
getting deals to pencil with a 0% rent growth is challenging. So,
Right.
but I do agree with you. It is a very interesting time. It's interesting to see these market cycles from early 2000, .com bubble. I wasn't in real estate then. I was just watching it from a tech world, to the 2005 when I actually sold my townhouse at the height of the market. It was awesome. And then
Right.
in 2008, I sold my last flip like September of 2007, I think. It was like 5 days on the market, and then it kept going up and up and up. And I sold it like on the 30th day. I'm like, whew, got out of that. And then it's been interesting as well. What are you most excited about right now, Paul?
Honestly, that's kind of a change of topic here, but we were LP investors as a fund in, tens of millions of dollars worth of deals. We've got about 195 million in equity under management. But about 2 years ago, we pivoted to preferred equity, and now we've pivoted again to JV equity. So we're coming in like our last deal was $51 million multifamily purchase. 30 million of that was Fannie Mae debt, and 6 million was from the GP friends and family. That 15 million in equity that was left, we brought in the middle of the capital stack. So we're not at first risk. The first dollar loss is all that 6 million above us, and the 30 million debt is of course in front of us as far as safety. But we're in the middle of the capital stack, but we're still getting essentially the same returns as the 6 million and that highest risk capital. And I love that place in the capital stack because it's giving us some protection. It's giving us forced sale rights, management control rights if they really screw up bad, but it's giving our investors essentially unlimited upside. Whatever the upside of the other folks is, we get as well. So we love that.
Yeah, I love that. And you keep kind of pivoting a little bit what's going on in the market right now. You had the pref equity, it lasted a little while, now joint venture equity.
Right.
And it's cool to see. It's cool to see you kind of evolve in that way. So, hey, Paul, how can people connect with you?
They can reach me at my website, wellingscapital.com, WELLINGS, capital.com. And if they want to get an ebook on mobile home park investing or my book on self-storage, my book on multifamily, they can get it at wellingscapital.com/resources. And before we go, Michael, I just want to thank you again for participating with us on fighting human trafficking and rescuing victims at aimfree.org.